Okay, everybody, we're going to get started. Again, thank you for joining me today. Morning or good afternoon, depending on where you are in the country. I'm Greg Yotis. I'm the Senior Sales Director here for Life and Annuities at Pinnacle. So today's webinar, we're going to cover the exclusive nationwide Peak10 fixed index annuity. We're going to highlight the strength of partnering with Nationwide and the strength of Nationwide as a carrier, the strength of this product particularly, and how it protects downside. It has downside protection while giving you great guaranteed income in retirement that you can't outlive. Before we get going into the presentation, just want to mention that in the handout section, I do have the Nationwide Peak10 rate sheet in there for you, and also the fact sheet. So those are two very important things to have just when covering the product. And if you have any questions, please feel free to type that into the chat, and we'll answer those questions as we go. So with that, we're going to get started. So the Nationwide Peak10 product is a fixed indexed annuity product. It's going to basically combine growth potential with market protection and guaranteed lifetime income. Like I said earlier, we want to just cover, why you, as an agent, you'd want to partner with Nationwide and how beneficial that is for your clients. We're going to talk about the features and positioning of the Nationwide Peak10 fixed index annuity, as well as look at some sales ideas to help you when you're talking to clients, and then answer any questions that you have. So, why partnering with Nationwide? Why is it important? Nationwide is a Fortune 100 best workplace, AM best rated carrier, across the board, very strong business practices, very strong brand recognition. All of us have probably heard the Nationwide commercials. So all of that is inside of Nationwide. Benefit to you as an agent is that your clients are going to recognize the name when you first present this product. The financial strength of Nationwide, they have over $123 billion invested. Capital strength, so that they're going to follow through on what they promise. But you could see how large net operating income, 1.4. I mean, they're one of the largest carriers in the world. A couple of highlights for Nationwide and their family of solutions. Annuity-wise, they're the 8th largest writer of fixed indexed annuities. They are the 5th writer of variable annuities, number 1 in fee-based. So they have experience across the board with annuities, and then they have strong life products as well. I'm not going to go too much into that, but very great and strong life products. Retirement solutions, everything is really geared to providing retirement solutions, and they work pretty hand in hand with the governmental 457 plans and retirement plans. So they have the retirement knowledge to be able to offer a product like this that gives you guaranteed lifetime income. So, couple of the highlights of the product that we're going to cover. Why is it important to protect from the market risk? Again, that downside protection that this product's offering. The growth potential with the guarantees. Those offer protection for any of those spouses out there that want to be protected. So you can have them as a joint annuitant on this. And then, like I said, the guaranteed income for life, so you're not going to outlive that. And as people live longer these days, that's more and more of a concern for people who are retiring. They want to make sure that they don't outlive what they spent their career, saving for retirement. So Nationwide Peak10 is designed for clients. This is going to be, the perfect candidate for what you're trying to do. They're seeking principal protection with upside potential. So if you take a look at the rate sheet, you'll see they have really high caps and participation rates on their indexes. So you have that upside market potential, but because it's a fixed index annuity, you are protected on the downside. So the worst you can ever do is a 0% return. So you don't have to worry about going into retirement and being 30% down if the market turns, and then wait all those years, if you have the years to wait, to have that come back to be at the level that it was when the markets took a downturn. If you're looking for higher interest rates than other fixed investments, this is where you want to be. It's going to outpace anything that you would see on a regular multi-year guaranteed annuity. You're going to have higher interest rates and higher caps and participation rates. Like I said, less risk than if you were in mutual funds or stocks or variable annuities. And if anyone, if anyone says that they have any type of retirement savings, 401ks, the light bulb should go off, and you should be thinking about the Nationwide Peak10 to roll that into, because it makes a lot of sense, and we'll get into why it makes a lot of sense. So just to go into some of the product details, it is a single purchase payment annuity, so it's only one premium goes into it. I will say one of the sales ideas, and we've been seeing a lot of this, is you can actually write two products and kind of ladder it. So the easiest way to think of that is if somebody had $500,000 and they said, in the beginning stages of retirement, I'm not going to need as much income as I will later on. So you could ladder it and do $250,000 in one product, or in one Peak10 product, and maybe turn the income on right away, day one on that one, and then have another $250 in the second Peak10 product. And you can delay and wait and really recoup what you'll see here with the income rider, and turn that income on later on. So that's just an example of kind of laddering the product by actually writing two separate Peak10 products for one client. But it does take non-qualified funds, IRAs, Roth IRAs, SEP, simple IRAs, any of those qualified funds, you can roll those over into it. Minimum investment for the product is $25K. That's both for the qualified and non-qualified. Unfortunately, there are no subsequent payments. So like we said, it's kind of for that single premium rollover scenario that makes a lot of sense. So death benefit is going to be equal to the contract value. You do have a joint option there for a spouse as the co-defendant with that death benefit, where they have the option of either taking a death benefit or continuing the product. Issue ages for this are 85 up to 85. No limit on the owner. So if the owner is different than the annuitant, but generally it's age 85 for the annuitant. Now on the income rider, you do have to at least be 45 years old to actually turn or utilize the income rider. Surrender charges, it's a 10-year product. You see the surrender schedule right there, 10, 10, 9, 8, 7, 6, 5, 4, 3, 2, and then 0. There is a terminal illness or injury waiver. So if they after the first year, if they become terminally ill or have an injury, they can, and they need the money, they can waive the surrender charges. There is a 10% free withdrawal, like most fixed index annuities. They could take out up to 10% of that penalty free. However, it will negatively impact your future income if you take a withdrawal like that. There is a long-term care waiver, so you can waive the surrender charges if you go into a long-term care facility or you need long-term care. And there is a market value adjustment on there. So easiest way to explain that is depending on where the markets are when you take that distribution, they will adjust your distribution either positively or negatively depending on where the markets are when that withdrawal is taken. So looking at some of the quality of investments and the variety of choices that you have as far as the indexes, they have the AB Growth and Value Balanced Index, H Factor Index, JP Morgan cyclical index, S&P, regular composite index, and then the S&P daily risk control. So, with those, the growth and value is a balanced option as far as the index. If you're looking for some global exposure, that's the H factor index. JP Morgan cyclical index is just looking to take advantage of what's going on in the markets, and then you have your normal S&P 500, S&P 5 daily risk control. So let's take a look at how it protects the spouse. For here, the need is you have a 65-year-old couple. One spouse can expect to live into their 90s. So the joint option on the death benefit allows the annuitant contract to name a spouse as the co-annuitant, and this allows the death benefit to be paid to either the spouse, no matter whatever spouse, no matter who passes away first. So it gives you some flexibility there for the spouses when you have a husband and wife looking for retirement income and investing the money. So here's just a little diagram kind of showing you how that works. So in scenario here, we have Mark and Lisa. Lisa's the one who's purchasing the annuity. Mark is named as the co-annuitant. On the left-hand side here, the joint option on the death benefit is activated or chosen. So if Mark passes away first, Lisa can take the lump sum payout of the death benefit, so they can use that for whatever they want, or Lisa has the option to continue to contract at the death benefit value if she chooses. So that may actually be higher than what her income benefit base is. So and then she can name a new beneficiary so they can keep that all of those assets in the same family. In the scenario that she doesn't name Mark as the co-annuitant, and there's no joint option taken. If Mark passes away, there's no death benefit, and there's no change to Lisa's contract. So she just keeps on. Lisa would just name a new beneficiary. So gives you a little bit of flexibility when you're doing some of the financial estate planning, legacy planning for your clients. So let's take a look. This is just a hypothetical illustration. So we're going to see they dropped in $100,000 here, which is the contract value for a 65-year-old day one. Death benefit is that $100,000. Income benefit is $100,000. So this is an example of with no income rider selected, but you see, because of the earnings potential here, in 10 years, that $100,000 has actually grown to $298,000. And the surrender value is now done since it's year 10. So it's the same across the board. So with the two guaranteed income options, you have two options in there. They have the guaranteed income solution, which is free. There's no charge for that. Zero cost is built into the benefit. And then you have your bonus income rider, which is the one we see most people choosing because of the strength of that rider, and we'll get into the specifics of that. But they're willing to pay that little bit of a charge for the higher roll-up and payout percentages for that income rider. So makes a lot of sense. So first we'll take a look at option one, which is the guaranteed solution. So with that guaranteed solution, which is in there at no cost, it's going to give you a 4% guaranteed simple interest on your income benefit from year 1 all the way to year 10, or until you start to take the income. So, if you have any of those flat years with your investments or your index returns, you're still going to get that guaranteed 4% simple interest for your income benefit. And that could, that'll keep your benefit high. And then if your contract value actually surpasses that, they'll reset your income benefit to match the higher contract value. So that's all that diagram is actually showing. And you can see that kind of in there, year 9. They have it shown where the actual cash contract value surpasses that 4% simple interest return on the income base. So a little bit more. Here's a kind of a example. Samantha, she's 65. In the first scenario, she decides to begin taking withdrawals immediately. Excuse me. So she's putting in $100,000. She's going to get her lifetime withdrawal percentage based on her age is 4%. So her lifetime withdrawal percentage day one is going to be $4,000. After 15 years, she's already received $60,000 cumulatively of her 100,000 she put in. So that's the benefit of the guaranteed income, because she's going to continue to get that $4,000 a year for the rest of her life, no matter what. And then in scenario two, if she waits the 10 years and lets that 4% interest, and now she's at an older age, so now her lifetime withdrawal percentage goes up to 4.5%, and her growth in her income benefit, because of the 4% simple interest, grows her 100,000. It's now grown to 140,000. Now she's just increased her income in those 10 years to be with the same amount of money, but now her income is $6,300 a year. And after 15 years, she's already received $94,500 of the 100,000 that she put in. So that's just after 15 years. And again, she'll continue to get that $6,300 for the rest of her life. So just take a quick step back. We do have a couple questions. So some questions in there. Do RMDs impact the 10% withdrawal? The RMDs would not impact that 10% withdrawal. Generally, those RMDs in the early years are going to be less than the 10%. So the RMDs do not affect the 10% withdrawal. And then there's a second question in there. So yes, the question is, can you periodically put in Roth conversions as the time goes on? So you can, that would be more of a laddering situation where you're dropping in, 20K every other year of the Roth conversion. Granted, it has to be at least 25 because the minimum on the product is 25, but you can do multiple policies of the same product as you drop in the Roth conversion. So hopefully that answers those questions. We'll take another look here of a sample illustration. So this is, again, most recent 10-year non-guaranteed hypothetical illustration table. In this one, person 60, they're dropping in $500,000. Death benefit is $500 day one. Guaranteed income benefit is $500. And then it's going to grow to $520. And then you see by the time they want to start taking income at age 65, you're going to see their income benefit base is $850,000. So that's more than their contract value. So now they're getting more income. Income day one would actually start at $34,039. Oops, sorry. Actually, yep, $34,039. Actually, year 8, it would be as it can grow because of market appreciation with the indexes, and that income can actually increase to $52,682. Death benefit, because now you're getting those returns still while taking out the income, still allows your death benefit to increase in your or contract value. Cumulative withdrawals, though, over that time, about $2 million by year 25, so at age 85. So you can see the real benefit of never being able to outlive that income, plus still being able to keep that contract value in place and even have that grow with some really good earnings potential with the incomes, with the indexes. Now let's take a look at option 2, which is the bonus income rider. So with the strength of this and what you're going to get with this option 2 bonus income rider, you get a 20% bonus day one. So your 100,000 goes up to day one, 120,000 of your income benefit. And you're going to get, for the first 8 years or until you start your income, you're going to get an 8% guaranteed simple interest on that income benefit. So really maximizing your dollars for future retirement income. And again, if your contract value does outpace the 8% and 20% bonus, they will reset that. But as you can see here, with the 20% and the 8% guaranteed interest, that pretty much stays ahead of the contract value in the first 10 years. So our second scenario here is Darren. He's 65, wants guaranteed income for retirement that he can't outlive. So in the first scenario here, you're going to see he drops in $100,000. Day one, his income benefit base is $120,000. Because of his age, at 65, you're going to see he has a 6.25% withdrawal percentage, which is a really good percentage. And he's going to get $7,500 lifetime income withdrawal. After just 15 years, he's already received $112,000 of that, and he's going to continue to receive his income even after that. So well worth it in that short time frame. And then scenario 2, if he waits a little bit longer, so if he waits the 10 years and lets that 8% simple interest roll up really benefit him before he starts taking withdrawals, he's already up to $216,000. And remember, that's a guaranteed number, right? Because it's guaranteed every year, so no risk there of any kind of downside risk. So he's $216,000 is his benefit base that it's grown to. Now he's older, so now he's 7.35% withdrawal percentage, because he falls in between the 75 and 80. He's going to be getting $15,876 in lifetime income, and he's already received $238,140 after 15 years of those cumulative withdrawals. So really, really good way to expand that $100,000 he had originally set aside for retirement and wanted to get income for it, by kind of planning ahead and then waiting those 10 years can really, really expand what you're able to do with just $100,000. So again, just looking at the illustration here, couple things in this scenario. 60-year-old puts $250 in. And this is a lot of what you would do when you're presenting it to a client too, is looking through this and kind of showing them the numbers, because in a lot of cases clients don't believe what you're telling them when you say 20% bonus and 8% guaranteed roll up. So this ledger actually shows you here $250 going in. Automatically your base income goes up to $300,000. If you wait, your benefit base is $420,000 if you wait just 5 years before you start taking the income, and your income starts out at $23,940, and then continues to grow with the earnings potential there. Still being able to have a nice death benefit, even with getting that guaranteed income, is really huge. You see a lot of other products, the contract value without the higher percentages on the participation rates and the cap rates, they may go to zero by the age 85. This continues to grow, still while taking that income out. So a couple things, like I said, with that income rider, the issue age to get that rider is 45 to 85. If you're doing the joint income, so it does have the joint income option, which we saw on the previous page, you take a little bit, let me go back, if it's a joint payout for a couple, you take a little bit less of a payout because it's covering 2 lives. But you can definitely do that, so that way, both spouses are well protected with that income. The only difference is it's a 1% cost for the single life and 1.3% for the joint life. So you pay a little bit more since it's covering 2 lives. Very reasonable cost for a rider with this this amount of strength. So yeah, this is just kind of talking about your option here, ability to take one non-lifetime withdrawal. So you can take one lifetime withdrawal before you start the income, and it won't stop the actual roll-up. So if you get into a situation where the client actually needs to take money unexpectedly, they can do that, and it won't stop that roll-up for the first 10 years. So just to kind of recover what we talked about, market protection from market risk. I mean, the markets are very volatile these days, so being able to have that downside protection is huge, especially when you're getting close or entering retirement. The growth potential is there with the index and the strength of the caps and the participation rates. You have some protection built in and flexibility for your spouse, and then that guaranteed lifetime income, which you can't outlive. And as we know, most people don't have pensions nowadays, so I always say it's like giving yourself a personal pension. So a couple things just to highlight. Take a look here. This is what's in there for the fact sheet. So kind of a simplified version of what we went through, kind of detailing all the specifics of the product. And then again, the rate sheet. So you could see here, as I was saying, 9.5% cap on those indexes, which was really strong. Participation rates, 250%, on the growth and value, 225% on the S&P Global Index. You can have option B, so if you wanted to, and those are on 2-year segments. So the first option has a spread, so basically you would there's kind of like a 1% charge built into that that they would take off of the return, but you're getting 225% of the participation rate. And then option B with no spread, so you get a little bit lower of participation rate. I'm actually, I kind of prefer option B without the spread, even though it's a lower participation rate. Just think it's easier for clients to understand. There is a fixed interest option too for a 1 year. So, 3.8% if you're under 100,000 or at 100,000 or more. 3.55 if you're under the 100,000. So really strength there, so keep those handy. There is one other question in here that I think just came in. It says, do any of the product have an income doubler for long-term care alternatives? So this particular product does not, but we do have some other carriers that offer some LTC alternatives with the fixed index annuity. So Pauline, I can follow up with you after the call, and we could talk about some of those options for you as well. All right. With that, I would say if even if you don't have a case right now, go ahead and let's get registered or appointed with Nationwide for the Peak10 product. You can simply do that by going to the website and go under contracting, and then at the bottom half here, you can put in, if you're already with Pinnacle, you can put in your appointment request for Nationwide Peak10. If you're new to Pinnacle, you can hit contract now and actually complete your contracting online and request a Nationwide Peak10 that way. So this way you're ready to go when you talk to anyone. Please remember, anyone who is closing in on retirement or has retirement assets that they're looking to generate a guaranteed lifetime income, please take a look at this product. You can give me a call, send me an email. Happy to run you an illustration that you can show to your clients, talk about it and see where it makes sense, especially if it's a laddering situation, so we can help you through that. But yeah, that's the Peak10 product, probably our #1 seller on fixed index annuity income products last year. without a doubt. So, yeah, thank you everyone for joining me today. Really excited about this product. So, any questions, let me know. I will talk to you on the next call. Everyone have a great day. Thank you.
Don't forget to subscribe to catch the latest news in insurance and agent training. See you in the next video.